As we did with prior chapters, I want to provide an overview of standard cost and variance analysis within the context of trying to answer the two questions: are we profitable, and is this job or product profitable? Answering these questions requires the application of the matching principle. In Chapter 2, we discuss matching costs within a job order costing system. In Chapter 4, discuss matching costs within a process costing system. Recall that in both systems, our period costs flow directly to the income statement, while product costs are capitalized. They flow into inventory and are matched with revenues when we actually deliver the product or sell the goods. Inventory at that time is reduced, and we record an expense called cost of goods sold. The matching of direct material and direct labor cost in a job order costing system was done using material cost cards and timesheets, and it was fairly straightforward. If the job is partially complete, all of the cost will remain in work in process, and when the job is fully complete, its costs are transferred to finished goods, and finally when the job is shipped, its costs are transferred to cost of goods sold. Matching manufacturing overhead is somewhat more difficult because overhead by its very nature cannot be traced directly to a specific job. Instead, it must be allocated, and we did this using a predetermined overhead rate and an actual activity base. In process costing systems, matching costs is more difficult. In addition to allocating overhead costs to units, we must also allocate direct material and direct labor costs. We must do this because we have units in various stages of completion. Remember the production reports and calculating equivalent units of production back in Chapter 4? One advantage of using standard cost is that it makes the process of accounting for manufacturing costs less time-consuming. But a more important and equally important use is the use of standard cost makes performance evaluation easier and more timely. What are standard costs? A standard is a benchmark or norm for measuring performance. In managerial accounting, we typically have two types of standards: quantity standards that specify how much of an input should be used to make a specific product. For example, an auto service center like Firestone's and Sears set labor time standards for the completion of work tasks. Fast food outlets such as McDonald's have exacting quantity standards for the amount of meat and toppings we use on particular sandwiches. And then we also have cost or price standards. They specify how much should be paid for each unit of input. For example, hospitals have standard costs for food, laundry, and other items. Home construction companies have standard labor costs they apply to subcontractors such as framers, roofers, and electricians. How do standard costs make accounting easier? In a traditional accounting system, when actual costs are incurred for direct materials and direct labor, or overhead, they are recorded in work in process. Then, in order to transfer units or cost to another department or finished goods, we needed to calculate the equivalent units of production and prepare a production report to properly allocate those costs between work in process, ending work in process, and the cost of units that were transferred out. In a standard costing system, rather than calculating an equivalent cost per unit, a company uses standard cost. It records costs based on predetermined standards rather than actual expenses or costs. As units are started into production or transferred from one department to another, they are transferred based on standard costs rather than actual costs. This allows us to transfer units or cost without calculating our equivalent units of production or needing to prepare a production report. For example, if the standard cost for a single unit is $4 for direct material, $9.50 for direct labor, and $3.50 for overhead, then a company will record a total cost of $17 for each unit of product that starts into production and a cost of $17 for each unit that is transferred out. What's next? When using standard cost, there's always a chance, in fact it's quite likely, that the actual cost we incur will be different from the standard cost assigned to each unit. In the next few slides we'll examine what to do with and how to interpret this difference, but first a brief review. When we applied manufacturing overhead on the basis of a predetermined overhead rate, it was likely that the amount of actual overhead incurred during a period was different from the amount that we applied. we referred to this difference as either over or under applied overhead. When actual overhead is more than the amount that is applied, we have under applied our overhead. When the actual overhead is less than the amount applied, we have over applied overhead. And recall, we simply closed out any over or under applied overhead directly to cost of goods sold. We will have a similar situation when we use standard cost to account for direct material and direct labor cost. The difference between the actual labor cost or actual material cost incurred and our standard cost is referred to as a variance. And that will be the result of either paying higher prices than expected or from using more of a particular resource than we had originally planned. Let's go back and look at Larry's Lawn Service and take a look at our gasoline supplies. We had a planning budget of $4,500 and an actual results for the month of $5,100. And we identified the total variance for our expenditures on gasoline and supplies as $600, and we said it was unfavorable because our actual cost was higher than our original plan. But to provide a little bit more insight into this $600 variance, we found it was useful to prepare a performance report that broke the $600 variance down into two components: an activity variance of $450 in this case, and a spending variance of $150 in this case. In this chapter, we're going to break down that $150 spending variance and look at it a little bit closer. We're going to break our total spending variance down into two parts: a price variance and a quantity variance. The difference between actual prices and standard prices gives rise to our price variance. When we look at differences between actual labor rates and standard labor rates, we'll get a labor rate variance. And when we look at the difference between our actual variable overhead spending and our predetermined variable overhead rate, we'll have a variable overhead spending variance. Differences between actual quantities used and standard quantities give rise to quantity variances. And again, we can have a materials quantity variance, a labor efficiency variance, and a variable overhead efficiency variance. Regardless of the name, we'll find that all of our price variances or rate variances are calculated in a similar manner, as are our quantity variance efficiency variances. Here's a general model for computing standard cost variances. On the far left, we have actual cost, which we can compare with standard cost, which appear on the far right. The difference between the two is our total spending variance. And to gain a better insight into the cause or source of this variance, in other words, was it due to differences in prices or differences in quantities, we need to introduce a center column, which is simply the actual quantities multiplied by standard prices. The difference between our actual cost on the far left and the center column is due to differences between actual prices and standard prices, and that's referred to as our price variance. The difference between standard cost on the far right and the center column are referred to as quantity variances. Without getting into too many details, let's take a look at an example using a three-column format. In the far left-hand column, we have actual costs. This is the actual quantities used and actual prices. The actual cost for direct materials used during the period was $6,630. In the far right-hand column, we have standard costs. This is standard quantities allowed and standard prices. The standard cost for direct materials used during the period was $6,000. This gives us a total direct material spending variance of $630. The variance is unfavorable because our actual costs were higher or more than our standard or expected cost. Now let's investigate the source of this unfavorable variance. To do this, we must add that center column. In the center column, we have actual quantities multiplied by standard prices for a total of $6,800. So we can break down our $630 unfavorable variance into two variances. a $170 favorable price variance. Notice it's favorable because our actual price of $3.90 per pound was less than our standard or expected price of $4 per pound, and a $800 unfavorable quantity variance. Notice the quantity variance is unfavorable because our actual quantities used was 1,700 pounds, and at standard, or we would have expected to only use 1,500 pounds. So again, referring back to the Chapter 8, we can calculate a total variance, which was a difference between our planning or static budget and our actual results. And in the case of gasoline and supplies, it was a $600 unfavorable variance. We broke this variance down into two components, a $450 unfavorable activity variance and a $150 unfavorable spending variance. And then we said that spending variance could be due to two things. One, we could have purchased more than we needed or used more than we needed. And two, the price could have been higher or lower. So we broke the $150 spending variance into two components, a price variance and a quantity variance. Thus, in summary, a standard costs and variance analysis help us answer those two questions. Are we profitable? And is this job or product profitable? They do this by simplifying accounting and by providing a means to investigate differences or variances between our planned and actual performance.